Want to start out today's podcast by talking a bit about the markets because today was yet another day in a string of 52-week highs for the NASDAQ. Not a record high, but a new high for the year. And it seems relentless because it doesn't really matter what happens to the overall market. The Dow is down about 140 points, I think about a third of a percent today, or I don't know, whatever what the percentage was. But the NASDAQ just continues to go up, and it's really being led higher by the big tech, Microsoft, Facebook, NVIDIA, Google, or Alphabet rather. These stocks are the leaders making 52-week highs, and I'm sure there were a lot of people that were short these stocks. I mean, after all, they got beat up pretty hard in 2022, right? The NASDAQ got crushed down, 30%, whatever it was, led lower by these stocks. And so probably a lot of people were short these stocks and they're covering. And that's, contributing to the buying. But to really kind of put this divergence in its perspective, just before I started this podcast, I was taking a look at the numbers and going back to January of this year. If you look at where the NASDAQ peaked at January, the NASDAQ is 20% higher right now than its peak in January. And you contrast that to the Dow, which is only about 3% higher than its January peak. So we're, not quite halfway through the year, but the Dow has made very little progress versus an entire bull market in the NASDAQ, up 20%. And again, it's very narrow because most of these NASDAQ stocks aren't doing this. It's just the really big companies. And again, they have some type of, AI theme going to them, which is part of what is, I think, driving the speculative flows into these names. But also, if you even look at compared to where everything was in March 17th, if you look at the high, the NASDAQ is up another 10.5% just since that time period. But if you look at less speculative names, like look at the ARK Innovation ETF, which had been, positively correlated to the NASDAQ in a bigger way. So if the NASDAQ was up 10, you might have expected an ETF like that to be up 20. Instead, it was up just 5% during that same time period. So again, this shows you that everything is concentrated in big tech. And by the way, Bitcoin is not going along with the tech ride. Since March 17th, about that time, where the NASDAQ is up better than 10%, Bitcoin is flat. Bitcoin hasn't gained at all. In fact, it's lagging behind the ARK ETF. There used to be a very strong correlation between Bitcoin and the ARK, innovation ETF, and that is broken down. Bitcoin isn't correlated to any tech anymore because it's just kind of flat line as all this tech is going up. Now, I know a lot of people in the Bitcoin community are saying, well, that's because it's now correlated with gold, right? Because gold has kind of been flat for the past couple of months. In fact, gold is only about 1% above its January peak. And by the way, to show you where the sentiment is, the GDX gold stocks today closed 4% below the January peak. And the juniors, the GDXJ, they're 8% below their January peak. So even though gold has gone up a 1% higher than its high water mark in January, the junior gold mining stocks are 8% down from where they were when gold was 1% lower. So that shows you the investors' mentality. In fact, investors are selling gold stocks, or they probably don't even own them, so they can't really sell them. Maybe they're shorting them, and they're buying tech stocks. But why are they doing this? What is the driving force behind this? And in fact, before I get into it, though, just to make one point on Bitcoin before I move away from this topic, I think the fact that Bitcoin is no longer moving up with these spec names, that is a bad sign. It is not a good sign that, well, now finally it's digital gold and it's correlated to gold. I don't necessarily know that logic is going to flow. what may in fact happen is that when gold finally breaks out of this range and gold stocks break out, maybe Bitcoin won't follow gold either. And if it's not going to follow tech higher and it's not going to follow gold higher, then what's it going to do? Well, it's just going to drop, because I know it's not digital gold. It was reinvented as some type of highly volatile, correlated asset to risk on. But if it's no longer correlated to tech, and if it's not correlated to gold, then it's correlated to nothing, and it's just going to go down because there is no reason to buy it. But anyway, so what I think is driving the move into tech, apart from AI, which is just part of the theme, is the belief that the Fed is either done hiking or close enough to being done that the traders can now see the whites of the eyes of the first rate cut. And that's what the markets are doing. They are looking beyond the rate hike, whether we have a rate hike in June or not, and whether or not there's another quarter point hike. I mean, either we've topped out now at 5 to 5.25, or maybe the markets think another 50 basis points max, 25 basis points maybe, and then that's it. So we're 90% of the way done with the tightening, and there's just this little bit left before we get relief, before we get more of the drug in form of rate cuts or expanded QE. And the tech stocks, the tech investors are anticipating that the next round of monetary easing will be just as good for tech as QE1 or QE2, 3, or 4. Everybody expects more of the same. And one of the reasons is because they expect the inflation rate to come way down. And so they expect us to return to the same Goldilocks environment that the tech stocks were operating under for the past decade or more, which is an accommodating Fed with cheap money, low interest rates, all in an environment where inflation is perceived to be below 2%. That is the sweet spot. That's what these high multiple stocks need to justify the valuations and to continue the flows that are necessary to keep these stocks going up, because it's not the earnings that are going to power them. It's not the dividends that are going to power them. It's going to be the momentum of money chasing them, which is a byproduct of the monetary policy. Well, I think they're wrong. I think that they're right in sensing that the Fed is getting close to the end of this cycle, although they're wrong in their belief that the Fed is going to be able to complete another easing cycle. See, I think that even if we peak at 5 to 5.5, that after the Fed starts cutting, they're not getting down to 0. They're not even getting to 1. They probably won't even get to 2, because at some point, inflation is going to be running so hot that they're going to have to do an about face. They're going to have to start hiking rates. And that's what the markets are getting wrong. That's what the bond market is getting wrong. They're right about sensing the recession, but they're wrong in assuming that recession means a return to 2% inflation. It doesn't. The next recession is actually going to be a catalyst for a dollar crisis and a resurgence in consumer prices. So inflation, as measured by the CPI, is going to be headed higher as the economy and markets are headed lower. And that is the outcome for which nobody is prepared, including